Next question. Company X and Company Y are identical in all respect, including the risk factors for the debt equity. X having issued 10% debentures of rupees 18,000, Y has issued only equity. Both the companies earn 20% before interest and taxes on their total assets of 30,000. Assuming a tax rate of 50%, highlight the portion tax rate of 50%, and capitalization rate 15% for an all equity company. Compute the value of X, value of the Y, overall cost of capital using NOI approach. I request all of you to do answer for company Y, value of the firm and weighted average cost of capital, and put your answer in the chat box. So write down answer. Calculation of calculation of value of firm, comma, weighted average cost of capital using NOI approach with taxes. Again, there are two companies X and Y. We start with the operating income. It is 30,000 into 20 percentage, 6,000 less interest, 0. Earning before taxes is 6,000. Earning after taxes is half because tax rate is 50 percentage. So this is 3,000. Cost of equity is 15 percentage. So value of equity is 20,000. It is 3,000 divided by 0.15. Value of debt is 0. Because Y is an unlevered form. Value of firm is value of equity plus value of debt 20,000. That is 20,000 plus 0. Weighted average cost of capital or overall cost of capital is 15 percentage. Dear students, you can see that yet I have not explained to you NOI approach with taxes, and we are able to do answer for the unlevered form. What I want to tell you is that say suppose in examination, whatever the approach which is asked in examination, say that you unfortunately forget. However, in that case, so you can of course do answer for unlevered form, because in unlevered form doing answer is very simple. Only for a levered form you have to think something, right? Yeah, let us come back to the point. So over here, so this is the way we make the computation of the company Y. Now I need to give some explanation to you. You do not have to write anything. Calculation of value of company X. Dear students, as per NY approach with taxes, the conclusion is like this. Listen carefully. With the introduction of the debt financing, three things happen. One, there is an advantage of raising lower cost of the funds. Advantage of raising funds at a lower cost. Second, risk for the equity shareholder increases, so cost of equity increases. And third, the company is getting advantage, that is the levered firm is able to get advantage of interest tax saving. Because of the interest tax saving advantage, levered firm has more value than unlevered firm, and a levered firm will have lower weighted average cost of capital than unlevered firm. I repeat my explanation. As per NY approach with taxes, what will happen? Three things will happen. One, levered firm will have the advantage of the interest tax saving. Second, levered firm will have advantage of the raising funds at a lower cost. And third, cost of equity for the levered firm increases. Because of this, that is because of the advantage of the interest tax saving, levered firm will have lower weighted average cost of capital and it will have more value of the firm. That is what it says. Now, how to make the calculation of the value of the levered firm is important, and that is what's the very first thing that say I am making a calculation and I am giving explanation to all of you. Everybody is requested to pay attention. So calculation of the value of the company X will have certain working like this. I request all of you to write down answer along with me. Then I'll give you the detailed explanation. Working note number 1, calculation of interest tax savings. Anybody can write in the chat box that what is the interest tax saving advantage that company X will have. Dear students, the interest tax saving advantage can be calculated as interest into tax rate. What is the amount of the interest? It is 1800. What is income tax rate? 50%. So what is interest tax saving advantage? It is rupees 900. This is the first working note that we are preparing. Write answer along with me. Working note number 2, calculation of present value of interest tax saving. Dear students, the present value of the interest tax saving can be calculated by one of the two methods. We know that say the company is going to get advantage of the interest tax saving for perpetuity. So what will happen? Listen carefully. The present value of the interest tax saving will be calculated as P0 is equal to A1 upon I. What is A1? A1 is the advantage of the interest tax saving that you are going to receive from end of year 1 onwards for perpetuity. So it is interest tax saving divided by rate of interest. Amount of the interest tax saving is calculated as interest into tax rate divided by rate of interest. We know that so the amount of the interest into tax rate is the interest tax saving, which we have found over here. It is 900. So it is 900 divided by rate of interest is 10%. That comes to rupees 9,000. This is the way we can compute the answer. Or otherwise, see, understand that say we can do answer of this by using a simple formula value of debt into tax rate. What is value of debt? 18,000. What is income tax rate? 50 percentage. That comes to 9,000. We can understand something like this. Listen carefully. Amount of the interest is calculated as value of debt into rate of interest into tax rate divided by rate of interest. I hope that everybody is clear. Interest is calculated as value of debt into rate of interest. Now what will happen? This rate of interest is cancelled against this rate of interest. So what will happen? It is value of the debt into tax rate. 18,000 into 0.5, that comes to 9,000. Directly we can calculate the present value of the interest received. Now the important working comes. Working note number 3. Calculation of value of levered firm. The term levered firm stands for a company which has introduced debt financing. So it is calculated as value of unlevered firm plus present value of interest tax saving. What is value of unlevered firm? It is an amount of 20,000. Plus, what is present value of the interest tax saving? It is 9,000. So what is final answer? 29,000. This is the way value of the levered firm is calculated. Now friends, we understand that the value of the levered firm is 29,000. Value of the debt is 18,000. So value of the equity can be found as balancing figure. So you make a backward working like this. So it will be found as 29,000 minus 18,000. So it comes to 11,000. That is the way the value of the equity is found. This is 6,000. This is 1,800. That is 18,000 into 10 percentage. This is 4,200. Earning after taxes is 2,100. Now cost of equity will be found as balancing figure. Why? Because as I told you that once again, the expectation of the equity shareholders will increase. So over here it is 2,100 divided by 11,000 into 100 for getting answer in percentage term. That is the way, so the cost of equity is calculated as balancing figure. And definitely friends, it will be more than 15%. That is 19.09. This is the way the cost of equity is found as balancing figure. I request all of you to write down answer. Now friends, we can compute the weighted average cost of capital and then we'll write a note. Write down answer. Calculation of weighted average cost of capital for company X. It will be by one of the two methods. The first method is EBIT into 1 minus T divided by value of the firm. Operating income is 6,000 into 1 minus 0.40 divided by value of the firm. That is an amount of rupees 29,000. So it is 3,000 divided by 29,000 into 100. That is the way weighted average cost of capital will be calculated. So 3 upon 29, 10.34 percentage. So 10.34 percentage. We'll do similar working for company, that is say the X company, using the detailed method. In that, if you wish to write KD is equal to rate of interest into 1 minus T, 10% into 1 minus 0. So it is 10% exact. Weighted average cost of capital. It will be found as cost of equity into weight of equity plus cost of debt into weight of debt. Cost of equity is 19.09 into weight of equity will be calculated as 11,000 upon 29,000. Cost of debt financing is, I'm sorry, this time it is 0.5, 5 percentage into 18,000 upon 29,000. This is the way we are required to make the calculation of answer. So it is 11 upon 29 will give the weight. Into 19.09. That comes to 7.24. 5 into 18 upon 29. That comes to 3.10. So that comes to 10.34%. Either of the way you can present the answer. See, basically, so there is a point that I would like to explain, that say, why do we compute the present value of the interest tax saving for the purpose of calculation of the value of the levered firm? Basically, what happens, that say the value of the unlevered firm that say we have is like in the present value term, it is in the year 0 term. So whatever the interest tax saving advantage which the levered firm is going to receive from end of year 1 onwards for perpetuity, all of them is required to be discounted in present value term to compute the value of the levered firm. That is the reason, say we calculate the present value of the interest tax saving to be added to value of unlevered firm to compute the value of levered firm. Yeah, write down a note for the answer. First point, as per NOI approach, with taxes an optimum capital structure exists. Second point, a capital structure having maximum debt financing will have weighted average cost of capital and higher value of firm. Full stop. As per NY approach, with taxes A, cost of equity increases with increase in leverage. B, company gets advantage of lower cost of funds. Full stop. With paragraph write down, above two values offset one another. C, levered firm has advantage of interest tax saving. Full stop. Advantage of interest tax savings will increase value of levered firm, comma, it will reduce weighted average cost of capital of levered firm. Full stop. Again, we have a diagram in which on x-axis we will have debt financing in capital structure. And on y-axis we will have cost of capital. This is cost of debt financing. I request you to put two things on your own: weighted average cost of capital and cost of equity. So friends, over here, when there is no debt financing, cost of equity and weighted average cost of capital would be same. When debt financing is introduced, cost of equity increases like this. Due to interest tax saving advantage, weighted average cost of capital falls like this. Again, weighted average cost of capital will not touch KD. Why? Because there cannot be 100% debt financing. So this is what we understand is like the kind of diagram NY approach with taxes. So revision of this NY approach with taxes. NY approach with taxes says that optimum capital structure exists, and a capital structure which is having maximum debt financing is considered to be the optimum capital structure. It says that say, with the introduction of the debt financing, three things happens. One, the company is getting advantage of the interest tax saving. Second, cost of equity increases. Third, company is getting advantage of the lower cost of the funds in the capital structure. These three things takes place. Because of the interest tax saving advantage, value of the levered firm increases. Because of the interest tax saving, its weighted average cost of capital is falling down. That is what we understand. Present value of the interest tax saving is calculated and say it is added to the value of the unlevered firm to compute the value of the levered firm. Present value of the interest tax saving can be calculated in a detailed method or a shortcut method. Importantly, the assumption is made that say that is a source of finance issued for perpetuity. Weighted average cost of capital as what we do normally, and we can see that say for company X, WACC is falling down. It is 10.34 in comparison to 15% of unlevered firm. This is the way the weighted average cost of capital for the levered firm is less, that is 10.34% over here, which you can compute by either of the method. This is what we understand as far as the NY approach is concerned. See, the cost of equity yet increases, but there is an advantage of the interest tax saving. So levered firm has lower cost of capital and higher value of the firm.